Is it your first time? Well, it's okay. Last year, over 150,000 people were having their first time too, so we're going to help you in this video. Hey, it's Gary from Let Property, and we help thousands of landlords every year buy and sell their tenanted properties through the sale of buy-to-let investments across the UK. I personally own a multiple seven-figure property portfolio myself, and I'm here today to help investors just like you enter the buy-to-let property market in a hands-off way. In this video, I want to talk about the one thing that really great investors get right, that new investors or guys entering the market just don't seem to really understand. I ask this question to you right now. What kind of investor are you? You see, any great or sophisticated investor that I've ever met has a plan. They understand exactly what properties they're going to buy, where they're going to buy them, and how they're going to fund them. They have all of the pieces of the puzzle fully worked out before they even enter, and it means that their journey on their path of actually investing into property is always a success every single time. The luxury I have is that we speak to thousands of investors every single month through our sales team, and one thing I get to see countless times is the people who are actually going to invest and the people who aren't. And the one thing that is abundantly clear is that someone that doesn't buy is someone who doesn't have a clear strategy or plan in place. They don't understand the criteria that they're looking for. They don't understand what they're going to do next. If you can build up this picture and this vision for what you're going to invest in, you will invest better, you will do it more wisely, and you will actually move forward and take action, which will make you become a successful property investor. So I'm going to put together what it is that we actually need to put together as investors in order to have a full criteria in place so that we know what we're doing when we're going to move forward and actually invest into property. So there's sort of three key areas for a criteria that I want to go over. And the first one is capital growth or yield. You see, generally speaking, capital growth and yield are on a tipping balance on each way of the spectrum. The higher the yield of the property, typically, the lower the capital growth potential of that property is. And the higher the capital growth potential, the lower the yield of the property is. If we think about a property in London, the yield of that property is going to be really low. That means the income generated on a property in London is going to be sitting at something like 3-4% in many cases. If you're lucky, you're going to get something at 5 or 6. However, if we look at a property up in Glasgow, we're going to be looking at a property with yields of 7 to 12% in many cases. It's a completely different market in Glasgow. Property prices are cheaper and you can pick up stuff that produces a higher yield. However, what area has risen more in the last 10 years? Well, obviously London. Anyone who's bought something in London in the last 10 years has probably done pretty well. That's because when an area has price pressure, it has higher demand, what it does is it obviously drives up the amount of people buying that property. And very often the rental market doesn't catch up with the sales market, which then reduces the yield of the property. It reduces the income that those properties receive. However, when you're investing in properties that have high yield, generally speaking, there's not going to be quite the crazy levels of demand, and the prices don't tend to rise as fast as properties in other areas where the capital growth is higher. So you need to decide if you're investing for cash flow. Many investors just buy properties that are really cheap, that just produce an income because they're looking to effectively get cash flow in their money straight away. There's other investors that are looking at things over 10, 15, 20 years, really buy into certain areas like London, for example. They don't even care about making money on their property. Very often there's London investors that actually lose money to own property in London because they're actually looking for the long-term growth of the asset. They're looking for the capital appreciation on that property. So you need to decide as an investor if it's capital growth or if it's yield that you're actually looking for. The second factor to consider is location. Location. Where are we actually going to buy and invest in property? One mistake I think a lot of new investors make is that they think they need to be down the road from their property. The reality is, if you're trying to invest in property and you're going to be the one dealing with your tenant, collecting the rent and sort of the driveway when a brick falls out, like that is not a good property investor, okay? The whole idea of investing in property, I always say, is to do it hands off and to hand this off to someone else who actually knows what they're doing for you, i.e. a letting agent. That means that you shouldn't be constrained by the location that you live in. You should be looking at investing all over the UK, all over the world even. Actually open up your mind and look for the best areas to invest in, because effectively what you're trying to do as a property investor is you're trying to take money, put it in somewhere and get a return. And what's to say that the area that you randomly live in right now is going to be the best returning location for your specific investment criteria? And then the final point to consider is really what I call the financial model, or the types of properties that you're going to actually invest in. Good, smart, and sophisticated investors have a very, very clear path in terms of like how many properties they're going to buy, what price point those properties are going to be at, and what that's going to produce them, okay? It doesn't take a lot of mental math to understand if you buy 10 properties at £500 a month rent, we're going to make £5 a month in free cash flow. Many smart investors will come in with that strategy in place. They know exactly what they're going to be investing over the next 3 years. They know exactly what they're trying to build up to, and they know exactly what the outcome's going to be. What you need to do is you don't want to come in and just randomly start buying all sorts of different types of properties. To be honest, not having a clear strategy or a clear exit plan as to how that looks when you have actually finished the goal. You need to actually come in with a clear strategy up front as to exactly what you're going to do and where that's going to get you to. This also falls into what types of properties you're going to buy. Again, ties in with whether we're looking for cash flow or capital growth. Are we looking to build a property company here that's going to have 10 properties in it that are going to grow over 10 years and we're going to turn $1 million into 5 million? Or are we going to do something here where we're going to just invest $1 million and we're going to get a 7% return on that money and we're going to live financially free for the rest of our life? You need to consider what your own strategy is and what your own goals are, and you need to build a clear plan as to what that's going to look like over the coming years for you to create your property investment portfolio. Anyone I know that has been successful has a plan, knows where they're starting, knows where it's going to end, and they understand what they're going to do next. And it means that they take the necessary actions in order to get the output that they're looking to achieve from property investing. I hope this video was useful. If you're interested in finding out why now is the best time to invest in property, then why don't you click the video up here and check out my argument on it.